Ladies and gentlemen, welcome back to the channel. Tesla stock was a clear outperformer today. Tesla closed up 4.31%. The stock was up close to 6%. It seemed like most of the day in the positive 5% range. Now here in this video, we're going to talk about why that is, what happened, and some of the news coming out. Gary Black says there is virtually a 0% chance that Elon's compensation package is rejected. And well, you know, today was a little surprising because Robin Denholm, the leader of the board at Tesla, said, hey, if the vote does not pass, like, we're fine just being a car company because Elon's not going to work at Tesla anymore. And that's all Tesla would be. Kind of surprising to hear comments like that, and Tesla up 5% for a majority of the day today. I think, again, reading the tea leaves here is suggestive that, market's confidence in Elon's compensation package getting approved is rising. And actually, when you look at Tesla from a technical perspective, the stock looks like it's about to explode. Okay, it literally looks like you're about to make a run to new all-time highs. We'll talk about that and much more in today's episode. But first, ladies and gentlemen, hit the like button as well as subscribe to the channel if you have not done so already. Check that link out down below in the description of today's video if you want to come join the trading community and come get involved in the action over there with us. Oh yeah, by the way, we're also going to share this clip from CNBC that says, quote, "You will see a 30 to 50% correction in many AI-related names next year," says Dan Niles. Yeah, that doesn't sound great. But obviously, come to your own conclusions. I'm not a financial advisor. So, first and foremost, let's start with some of the big news today I want to share with you. Gary Black says about 30 minutes ago, there is a near zero chance that Tesla shareholders will vote down Elon's new proposed comp plan at the November 6th shareholder meeting, as Wedbush analyst Dan Ives colorfully put it in a Yahoo Finance interview on October 23rd. Quote, "I have a better chance of starting for the New York Yankees than this comp package getting voted down." He says, amen. Okay? You know, logically you would expect that. Okay? Because if you own Tesla and you say, I don't want an 800% return, something is wrong with you. You're a hater. Why are you investing in Tesla if you're that big of a hater? Especially if you have a position large enough to actually sway the outcome of this vote. It's just, again, I've put it at like a 90% chance the vote is going to pass. I'm just like, I'm throwing out numbers there on my asshole, okay? I have no idea, but you'd have to imagine it's over 90%. Now, the State Board of Administration of Florida, which owns $1.23 billion of Tesla stock, says it is voting for Elon Musk's 2025 CEO Performance Award on November 6th. They say, quote, "If the 2025 CEO Performance Award achieves its intended outcomes, it would mark one of the most remarkable examples of performance-based compensation driving share owner value in modern corporate history. For shareholders, it would validate a bold governance strategy that aligns leadership incentives with long-term growth. For the investment world, it would set a precedent for how visionary leadership paired with ambitious yet measurable goals can deliver outsized returns and reshape expectations around executive pay and corporate performance. Critics of the 2025 Tesla Performance Award often overlook the simple fact that this exact model of incentive compensation has already proven itself twice over. The 2018 plans were derided in almost identical terms, excessive and outsized, yet both drove extraordinary shareholder returns. The 2012 package, contingent on a tenfold increase in market capitalization, was achieved years ahead of schedule. They go on to say the 2018 award, which ISS and Glass Lewis have criticized, required Tesla to grow from roughly $50 billion to $650 billion in market cap growth that was accomplished within only 4 years, creating hundreds of billions of dollars in shareholder wealth. In both cases, the dilution effect was minimal compared to the immense value creation for investors. Musk only benefited when shareholders benefited first. The same dynamic underpins the 2025 award. The milestones are extraordinarily demanding as they require Tesla to become an $8.5 trillion enterprise and to achieve operational breakthroughs in autonomy, robotics, and energy storage. For shareholders, this represents an upside bet. As Tesla achieves each of the targets in the plan, investors enjoy a significant gain in value. This is not moral hazard, it's alignment. Those who claim the plan is too large ignore the scale of ambition that has historically defined Tesla's trajectory. A company that went from near bankruptcy to global leadership in EVs and clean energy under similar frameworks has earned the right to use incentive models that reward moonshot performance. In conclusion, Tesla's performance-based CEO compensation plans have consistently driven extraordinary shareholder value, far outpacing industry peers and market benchmarks. The proposed 2025 plan continues this tradition, aligning executive rewards with ambitious, measurable milestones that benefit all shareholders, with robust governance safeguards, transparent succession planning, and a proven track record of value creation. We believe this plan sets the gold standard for consecutive compensation. For these reasons, among others, the SBA will be voting for the 2025 CEO Performance Award at the annual general meeting to be held on November 6th, 2025. So I don't think anyone else could have put that better. Shout out to Florida for that one. But this is something you're going to start hearing from a lot of big money, okay? BlackRock and Vanguard specifically, when they comment to how they are voting, is specifically going to move the needle for Tesla stock. Now, clearly, based on what was said today and Tesla's outperformance, up 4.31% to close out the day, investors are looking at Tesla as a cleaner and cleaner kind of cut and dry opportunity when it comes to the compensation vote. People are saying, hey, the vote's going to pass, right? Now, if Tesla were to sell off before November 6th, which is still possible, okay, that would be a little bit of a red flag, some people getting nervous, but the fact that the stock is rallying, even though, the consequences of a no vote for Elon's compensation package would be dramatic, is a very positive signal. Trump on Elon Musk today says, quote, "I like Elon. I've always liked Elon. He's a nice guy and he's a very capable guy. I like Elon and I suspect I'll always like him." So, that doesn't hurt. Now, again, just to reiterate what happened today, the VIX EQ, the equal weight VIX, has seen a sharp rise today. Wall Street is fearful about single stocks and earnings, okay? Big tech earnings are this week. They're hedging using smaller cap companies. That's why the Russell underperformed the NASDAQ so much today. The Russell was up 0.28%. NASDAQ up 1.86%. Institutions are hedging their bets with small caps, which makes a lot of sense for now. But after big tech earnings, once volatility collapses, hedge funds and institutions are going to start buying. Now, you also have the Fed meeting Wednesday, which Fed rate cuts disproportionately benefit smaller cap companies and risk-on areas, which Tesla is not a small cap company, but it is a risk-on area. And, quantitative tightening coming to an end. I don't know if that's going to happen, but JP Morgan says that it's going to happen. And that could also be a very favorable catalyst for Tesla and for, again, the risk-on areas of this market. Now, the CNN Fear and Greed Index today still sending a pretty clear buy signal. CNN Fear and Greed Index at the time of recording this video sitting at 37. You're still about midpoint of fear. Market momentum, extreme greed. Stock price strength is fear. Stock price breadth, extreme fear. Put and call options, fear. Market volatility is neutral. Safe haven demand is fear. And junk bond demand in extreme fear. If you look at the AI Investor Sentiment Survey, as we talked about in prior videos, about 43% of investors are bearish, 20.5% are neutral, 36.9% are bullish. You still have more bears than bulls. That is a good sign, for a contrarian. For someone that's bullish, You want to see this many bears. It's a good sign that stocks are going higher. Now, the percent of stocks trading above their 50-day moving average sitting at 52.12%, which is kind of neutral overall. That in and of itself does not send a very big signal. Now, in option activity today in Tesla stock, look at this from hedge funds and institutions. 235 different trades totaling $374.17 million, positive order value of 85%. Okay, institutions, hedge funds are not concerned that the compensation vote on November 6th is going to fail. Okay, so they're going out, they're making some bullish bets on Tesla. Okay, and you have to imagine that they're talking to each other. They're asking each other how they feel about this, and the consensus would seem to be they think it's going to pass. Now, once it passes, I think we have a really good setup ahead into year end. Again, as we talked about, big tech earnings are this week, the last earnings season of this year. Volatility collapses, hedge funds and institutions start to buy. Now, long story short, if you don't know, how that works, let me explain it like this. So I actually posted this in the trading community last night at 8:16 p.m. I say here, why the stock market is about to rally hard into year end. Number one, single stock volatility measured in the VIX EQ is about 50% of the peak back in April. So if you think about, the fear level, 0 being no fear, 10 being a 20% crash, you're at like a 5 right now, right? You've retraced to the upside 50% of the fear we had at the peak of April. I know it's a little hard to comprehend from that perspective, but it's probably the simplest way to put it. So there's a lot of fear out there, okay? But the VIX is back to lows. This is a record spread of fear in single stocks versus the index. This means investors are nervous about single stocks, likely because of earnings this week from the Mag 7 and concerned about AI guidance. Again, if Amazon wets the bed and they say, hey, we're slowing down on AI investment, we don't think this whole AI thing is going anywhere, which is not going to happen, but bear with me here. Yeah, sure, Amazon's going to fall like 5 to 10%, but some of these smaller cap AI companies are going to fall like 20%, right? If you had to hedge your portfolio because you're nervous about big tech earnings because of these risk events, it makes a lot more sense to hedge the small cap AI companies, doesn't it, right? You're going to get a much higher beta move based on that. And you don't need to short as much, right? A $200 million short can do the same in a small cap AI company as a $1 billion Apple short would do in Apple, right? So you can take a smaller amount of money, hedge, and that's what I would be doing if I was a hedge fund manager, okay, right now. If I was nervous about big tech earnings, I would be hedging in the small cap AI stocks, okay? Because they have such a high beta. Now, I say there is nothing to worry about there. Companies are fighting to stay relevant. They have no choice but to spend more and more on AI. We've talked about this before, but like Google, everyone is coming for Google's business, okay? ChatGPT, Grok, no matter who it is. Google has to spend. They have no choice. Google stops spending, they do not exist 10, 20 years from now. Okay, the same is true for all companies, whether you're Oracle or Microsoft or Amazon. Smaller players are coming for your data center business. If you do not invest and compete, you're not going to have a data center business like that 10, 20 years from now, okay? It's going to be the smaller guys that grow to be giants. You get the idea. That's happening on a countrywide level with AI, okay? I say here, hedge funds and institutions, they sell stocks and hedge as volatility goes up. I know it's ass backwards, but that's their version of risk management. Retail's version is buying the dips. So as single stock volatility collapses late this week, it will trigger massive buying pressure. Number two, Fed meeting on Wednesday. Fed fund futures markets are pricing in a cut at every Fed meeting from here into January 2026. 3 cuts total, and JP Morgan expects the Fed to end QT this week. QE, the opposite of QT, is the practice of the Fed buying assets like treasuries on the open market to control yields and keep them low. This started after 2008. This is because the Fed is only able to control short duration bonds, like 1 to 3 year bonds with interest rates. If they want to get long bond yields lower, which determines mortgage rates, etc., they typically have to buy them. QT is the practice of selling the bonds the Fed bought with QE. So if QE causes bond yields to stay low, well, QT causes bond yields to stay higher. So ending QT puts downside pressure on bond yields, which is good for risk assets and should be good for a stock like Tesla, right? I say this is because the bond coupon itself is fixed. Think of a dividend stock that never changes the yearly payout. The payout yield changes when the stock price, in this case, bond price, changes. Again, historically, QE is very positive for stocks, and ending QT should help bond yields fall and fuel this market to the upside. Number 3, Trump, China, Canada, things look to be improving on that front. We'll skip that for now. Number 4, historical data. Since 2012, the S&P has gained 4% in the last 10 weeks of the year. With a setup like this, the rally could be much more dramatic. I write, in conclusion, Monday is probably really green. Monday was today. It was really green. Tuesday could be mixed, okay? Some winners, some losers, a mixed day, not a really good day, not a really bad day across the board. Wednesday could be mixed as well until 2 p.m. Then I expect a rally post-Fed, okay? Post-rate cut, post-end of QT, okay? Thursday should be good following Meta, Microsoft, and Google earnings. And that takes place Wednesday and after hours, right? So I think you get a rally after the Fed into big tech earnings that, should fuel a pretty strong Thursday. Now, Apple and Amazon report after the bell on Thursday. That's going to be big as well. Friday, this is when the rally kicks into high gear heading into the following week, okay? I think we're about to have a 3 to 6 month pretty aggressive rally on our hands, okay? But you need to get through earnings, which big tech earnings until Thursday and after hours. The Fed is on Wednesday. Don't be shocked if the next 24 hours, not a lot happens, okay? But it's Friday that's going to be the really big day, in my opinion, that leads into next week. Next week could be explosive to the upside. And as I've talked about before, I think Tesla, could be getting ready for a pretty large breakout from here, potentially a test of new all-time highs. As confidence grows that the compensation package will get approved, Tesla will start to trend higher towards $500 per share. But there's still going to be some nervousness, okay? People are not going to want to go all in on Tesla before such a consequential vote on November 6th, which is what? Next week, if I'm thinking about it correctly? Yeah, next Thursday. People aren't going to want to go all in this week or up until Thursday of next week, right? But you could trend higher to about $500 a share. After that vote takes place, assuming Elon's compensation package gets approved, then you could see $100+ move and Tesla could be in the 600s within a week or two, okay? It could be very dramatic. Before we go ahead and wrap up this video, I do want to share this clip with you. It says you will see a 30 to 50% correction in many AI-related names next year, says Dan Niles, okay? Dan Niles is wrong quite often, but that's a pretty crazy headline. So take a listen.
Niles Investment Management founder and portfolio manager, Dan Niles. Dan, thanks for being here. Just to kick things off, how are you thinking about the week ahead, especially in light of all these kind of idiosyncratic pockets that we're seeing, stocks rise today, for example, Qualcomm?
Yeah, the way I'm looking at it is over the weekend, you obviously had trade deals with 4 different countries. That was a big positive. On Wednesday, you get the Fed meeting where you're going to get a cut, and you could argue 2 cuts in the sense that I think quantitative tightening will be stopped. And then obviously you've got 25% of the S&P 500 reporting between Wednesday and Thursday when 5 of the 7 Magnificent 7 report. And then Thursday you should have that meeting between President Trump and Xi, and you should get a framework for a deal there. So I think all of those things are going to drive stocks higher in a broad-based rally, and I think that's how you want to be positioned.
Do you think the bias is to the positive, that investor patience over higher CapEx will be tolerated as long as revenue is higher, as long as there's a framework for a deal, or as long as tensions just don't get exacerbated from here?
The big thing is when you have easy money, money flows everywhere, everybody's assumed to win. And as you brought up earlier, Qualcomm now is assumed to be a big winner in AI, but if you notice, NVIDIA, Marvell, and Avago, at least the last I checked, they were all up as well. So right now you're in this environment where despite investors going, well, how many have won in search? Well, it's just Google. How many have won in e-commerce? Well, that's just Amazon. What about streaming? That's just Netflix. What about audio? Well, that's Spotify. Right now, the assumption is everybody's going to win because you've got this easy money. You're going to get a rate cut. You're going to get quantitative tightening probably stopping. You'll get another rate cut on December 10th. You'll probably get another one to start next year in January. And then you're going to get a new Fed chairman in May that's going to want even more rate cuts. Right? So we've been through this scenario before in 2021. Inflation went from 1.4% to 7%, and the S&P was up 27%. And so you're in that same exact environment where everybody's going to win, enjoy the party as long as it lasts, and then prepare for a hangover sometime late next year.
Right. I was just looking at the last time the Fed cut, Dan, with inflation at these levels, October '08. Right. So how much are you worried about the other side of that mountain, as Tepper might say?
Oh, the other side of that mountain is going to be horrific. I mean, I believe that sometime late next year, you end up with a 30 to 50% correction in a lot of these AI-related names, but it doesn't mean, Carl, that between now and then, these stocks can't go up another 25, 50% or more, because you've seen this same picture show in the late 90s. And back then, the Fed was actually raising rates, don't forget. And the market still ripped. NASDAQ was up 86% in 1999, and then it started 2000 up 24% in just over 2 months. Obviously, the hangover on the other side was terrible, but you made a lot of money just sort of staying with it as long as the government kept screwing up and making, as long as you had investors believing everybody's going to win. And Qualcomm today, for me, the interesting part was all the competitors were up. And so we're still in that great mode of, hey, we've got all this money flowing into the market. It's going to find its way into all these different stocks.
Yeah, I feel like we.
Now, I actually want to warn you guys as a bit of an early warning, something that I've discussed with people in real life, with the trading community pretty extensively. And I think the first time I'm saying this on the channel, I actually agree with Dan Niles. Like, at some point next year, probably late next year, maybe early 2027, there is going to be a large correction in AI stocks, okay? That's why I've talked about on this channel, like, you do want to be a little selective in the companies that you are buying as far as AI stocks, right? Or at least understand the risk that you're taking, okay? You don't want to put all your money into an AI stock that has big promises, that is not putting out any guidance or any targets or like holding themselves accountable, right? You want to try to be reasonable. And I actually put it like this in an analogy today in the trading community. I said, look, you want to own a home in the best neighborhood possible, okay? You don't want to buy a home in the ghetto. You want a home in the best neighborhood possible. But you don't want the most expensive home in the neighborhood, okay? If you buy the cheapest, nicest home in the neighborhood, okay, if the houses go for $500,000 and you bought a really nice house at $350,000 and that market tanks, you're probably still going to be okay, because you bought a good deal. You want to buy good deals in this market. You don't want to just buy the hypiest high flyers. This is actively where we are pursuing in the trading community, okay? So come join it, link down below if you would like to. But here's the warning I have for you. In my opinion, the next 30 to 50% correction is not going to come from AI slowing down or AI investment slowing down, or one day Apple wakes up and cancels their AI projects and, people freak out. The 30 to 50% correction in AI stocks, and it might not be that aggressive, okay? But the next big correction comes from when China takes the lead over America, okay? The moment in which you have another DeepSeek that is not just a competitor, but something like, oh my gosh, maybe we're not going to win the AI race. that is when stocks are going to fall substantially. I believe that will be a buying opportunity, okay? But that's, in my opinion, what could give you the 30 to 50% correction. At some point in the next 12 to 24 months, you're probably going to get another report that says China is now ahead of the US in AI. I doubt that's going to be seen as favorable on Wall Street. And that could give us a correction on those kind of numbers. So again, like Dan Niles said, that's a long ways off from here. So there can be a lot of upside. But it does mean, again, you want to be selective. If you're in stocks that you don't believe in the long term, you're in more trading names, take your profits. Okay? Don't be afraid to take a profit in this market. Now, I think we have a good while until we're dealing with a correction like that. But you get the idea, right? And I would love to know your thoughts on what do you think could cause a correction like 30 to 50%. But the best guess, again, I have is China probably momentarily takes the lead in AI from the US, okay? Because that threatens just global dominance in general of America. So, like, that would not be good. And that is probably the biggest risk this market faces. So let me know your thoughts down below in the comment section. Check out the link down below in the trading community. Have a great rest of your day, and I will see you in the next one.